Okay, so let's talk about the agenda. So what we're going to talk about day one is, yes, we're recording this session. Day one, we're going to talk about expectations, trader psychology, 7DTE breakdown. What is the 7DTE? We'll review the 7DTE trade plan, entry, exit, adjustment criteria, entering the trade, and talk about ideal and not so ideal conditions. We're actually going to put on a real trade today, all right? And so on day two, we're gonna review everything that we reviewed on day one and ask any questions that you may have, because a lot of times you may think about it overnight and go through the presentation. I want to make sure that I'm able to answer all of your questions. What I'm going to be sharing is my entire trade plan, how I trade. There's no catch, no gimmicks. I'm going to share everything that I know, and hopefully it'll help you guys become a better trader. We're going to talk about when not to place a trade, technical analysis, and some common chart patterns that I like to review when I go through this kind of stuff. How we are rolling a threatened trade before it breaches, and how to roll a trade after it's breached, and on day three, actually, not day four. And we're going to review how to enter, again, the second DTE trade. Hopefully you'll have a little bit of practice and understanding how to do that. How to exit the trade, second review on rolling, because it can get, it can be a little bit complicated. And so I want to make sure that you guys cover that, because that's really the most important thing. And then conclusion and key takeaways. And so I'm going to be monitoring for questions here and trying to answer those as we go along. So here we go. I'm going to share with you real quick just the 2021 trade performance for 7DTE. And what I like to do is set basically a margin amount. And I really trade using, for 7DTE, mostly 6 contracts up to 10 contracts to the end of the year, divided by 3 different expirations. So if you take that margin, so let's say it's 6,000, right? So I use 6 spreads, 2 contracts each, right, for our spread. And then I use 6 contracts for 1 expiration, 2 expiration, 3 expiration. So that's a total of $18,000 of margin. So you take 18,000 or 20,000, that's pretty much what I'm using, and then I double it. So what I do here is I establish 40,000 because I use double the margin just for drawdown. So I'm actually trading 18 to 20,000 in margin, but I set aside 40,000 because of drawdowns, especially like now, we're in a drawdown now with the market going down. And that's how I calculate the amount of margin and what my rate of return is. Yeah, 1 small loss. These are calculated automatically from my account in the way that I have the integration with Telegram. So it's a great trade. You can make a lot of money on it. You just need to make sure that you really understand how to manage it. Okay, and we're going to be talking a lot about that. All right, so what can we expect? We're going to talk about psychology and the trader mindset, because this is one of the important aspects of trading. If you nail down the psychology and the trader mindset, the trading is basically tactical, and it becomes very, very simple. Okay, and I'm sure most of you already know that. Having a full understanding of the 7DTE trade plan, you will know how to place, manage, and close a 7DTE trade. And by managing, you will know how to adjust or roll a 7DTE in any market condition. And then you will understand the technical analysis for what I use on these trades and the indicators used to manage these 7DTE. And it's mostly support and resistance. And if you have a grasp on that, it's very, very powerful. All right, so let's go through the emotional causation examples of trading. So number 1 is greed. And what happens when we're greedy? It's usually because you probably have a smaller account. You have a short window to make these gains so that you can get to your trading goals, right? And what happens is just the opposite. So basically you're trading bigger, and it causes emotional decisions to be made when you're trading bigger, especially when the trade goes against you. Trading more frequently for faster gains. So trying to add more positions, get in there, get out, so that you can make that money and get things finished. Number 4, there's a way to take losses, hoping that the losses will turn into gains. And that's another causation as well. So you have 4 of these causations that greed causes. All right, fear. So let's talk about fear. Fear is, fear will cause you to take profits too early, number 1. Not trading thinking that you're going to lose because maybe you had a large loss earlier and you're not really thinking about your trade plan. It's just about, oh my God, I'm going to lose again. Not taking a loss, hoping that the market will come back. And those are the 3 things that fear causes. And then we have regret or remorse, basically. Regret and remorse happens because typically we take on a big position, we take a loss in that big position, and it's really hard to crank up again. You get discouraged, lack of confidence. Basically, your thought process is very negative at that point, okay? So you want to avoid that. What's the recipe to overcoming greed and fear? Number one thing, trade small. Trade small until you're profitable 70% of the time, all right? And that will help you learn your craft, right? So in any type of career or trade or anything that you do, you want to become proficient, and becoming proficient means that you're trading enough to develop those habits and to trade consistently profitable. And that happens over time. It doesn't happen overnight. Establish a trade size based on your account size. For every $10,000 of margin that you have for 7DTE, I trade one spread in 3 different expirations. So I'll trade 3 spreads, $3,000 for 7DTE, and then $1,000 for a monthly and $1,000 for 0DTE. And that's basically the guide that you should use for trading credit spreads. And the reason we only go up to basically 50% is because if you have a big drawdown, then you want to have the money to be able to adjust that trade and keep adjusting it until it becomes profitable. You have enough capital to go through that process. So if you're trading in your account all the way up to 10,000, the first drawdown, you're not going to have money to do a roll, all right? And that's what'll get you. This has happened to me personally. And it's really the best way to manage it. What I've found: review trade plan daily to ensure that you're sticking to it. Regret and remorse, walk away for a few days to clear your head. If that happens, just take some time off and think about it, and always have a no quit attitude. Because if you're going to make it in this business, you don't want to quit. You want to, even through your losses, and I've had big ones, and you will make it in the end if you don't quit. So I just want to encourage you for that. Remind yourself that others have done it, and so can you. If I can do it, and I have been a big risk taker, right? Too much for me, you guys can make it as well. Quick thing on mindset and discipline. I'll leave this with you. Always observe the habits of successful traders and what they're doing. Commit yourself. Define your morning routine and your afternoon routine. Understand the news events that may affect the trading day. And there's a lot of websites that will show you that, like Fed Day, the minutes of the Fed, or something like that, to make sure that you are clear in what's going to be happening that day. Be knowledgeable about what you are trading. If you want to become an expert at 7DTE, just trade 7DTE and focus on that. And know what your max loss and max gain is. That we'll be talking about that. Understand your trading platform, whether you're on E-Trade, Thinkorswim, Tasty Trade, whatever you're on. Really understand the tactical ways to manage those positions, because it's easy to make mistakes. For example, imagining losing, right? If you have a stop and it's getting close to that stop, think about taking that loss. So you don't have to take an emotional position on it, or decision on it, knowing that, okay, I'm going to take that loss. It's going to be gone. It's going to be over with, and that's it. It's part of trading, and we'll come back another day. Remind yourself that it's real money that you're trading, okay? Because it's very easy to gamify trading, thinking that it's just a game, because it's very easy to pop in an account, put some money in it, and start trading like a game. This is not a game. This is a profession, and treat it like a profession. I always say trade small, trade often, right? Very important to hone your craft and to keep it fluent. And trading small allows you to do that because you won't take big gains, and so you can trade a lot more, okay? And that's really the goal there. Alrighty. All right, now we're going to get into the trade plan. Let's talk about the 7DTE trade plan. And first, what we want to talk about, for those of you who don't really know what a credit spread is, I want to just go through that real quick so that you understand. Okay, a credit spread has a combination of 2 puts, 2 calls, where the put or call that's sold is more expensive than the put or call that it's bought. It is a credit spread, so you receive a credit when you put on that trade. Number 2, here is an example of a trade that comes from the Thinkorswim platform. You're selling the position to open it. So sell to open, okay? You'll hear about a lot. In this case, it's one vertical, so one spread that we're doing, and the vertical is made up of 2 contracts. It's made up of 2 contracts, so the one that you're selling and the one that you're buying. SPX 100 means actually the number of shares per contract. which is 100. It doesn't mean the SPX 500, okay, that we're trading on the S&P 500. This is SPX 100, which means one contract per share, or 100 contracts per share. These are weeklies, Monday, Wednesday, Friday, quarterlies, and end of month, right? That's when weeklies trade for SPX. On stocks, I think they're Friday, just Fridays, mostly not during the week. All right. In this case, this is a 23 December 2021. That's the date of expiration. This is the position, 45.75, the one you sold, 45.65, the one you bought. You receive a 65-cent per contract limit order, right? And it's called a bull credit spread. So the 65, you multiply that by 100, and so this position would net you max gain of $65. Okay, and that's how it works. So in this case, again, you're selling the 45.75 and buying the 45.65. The trade is considered to be a high probability trade. However, there are risks. The risk is that you're putting up, in this case, $1,000 to make 65. You heard about don't put pennies in front of the bulldozer or whatever, you know? Yeah, I've heard that too. So, but that's basically this trade. And what you get for it, a high probability trade, but you're putting up a lot of risk to make a little bit of money. And that's how it works. So in this case, the risk reward is $1,000, actually minus the credit that you receive, and the reward is $65. And the max loss in this case would be $935, which is also the margin requirement that you need to put up when you put on this trade. The actual risk in this trade is not $1,000, is $935, because you're collecting 65 on opening that trade. So why is this trade a high probability trade? And it's because you have decay in the options that you're selling. So in this case, from 68 to 33 days, the rate of decay is 34%. From 33 to 5 days, the rate of decay is 57%. And from 5 days to expiration, the rate of decay is 100%. So you put on this trade, and the result is that no matter what, this trade is going to expire in 7 days. And you need to do something with that trade so that you either make a profit or you take a loss on it, okay? And hopefully you won't take a loss, because we'll adjust it so that it works well. All right, so let's look at all the profitability factors. Applied volatility is number one. You want to enter a trade when the volatility is higher and get out of that trade when it's lower. It doesn't always happen that way, but that's really the ideal situation. Number two is theta. Theta we just talked about. Theta is the rate of decay or rate of decline in the value of the option due to the passage of time. That's a big factor for 7DTE in month. And then number three is the direction. So market direction, most of the time it's going from left to right, up. Most of the time I'll be putting on bull spread. So market direction, since the market is most of the time going up, I mostly put on bull spreads. And the other reason is because when you're putting on call spreads, they are much harder to manage or adjust just because of the nature of the option. It's closer to the money. Decay is a little different. Once it starts moving up and against you, it's very, very hard to manage that. And I've pushed out trades. I even have some call spreads that I pushed out to March, just because they're very, very difficult to manage. Let's go through the entry exit guidelines for 7DTE. Again, enter with small positions, relatively speaking, right, using multiple expirations. And so you put on one trade, you wait a couple days. That's really the best way to do this. It spreads the risk out. So entry should be done when there's, again, relative increase in volatility during market rallies. During market rallies, wait for that pullback to enter. And during those times, only put on a bull spread may be advisable, especially if the market is just ticking up. Lately, when we go through a correction, then it just feels really bad, right? when the market goes against you, but you have to be patient. In most cases, the market will correct, and look, do some research, right? Look at the market and measure how often and how far the market moves down in any given time. You'll notice that most of the corrections, especially lately, have been 5%, 6%, and that's it. And then it comes back. And during the time where rates are rising, like we are today, the market generally goes up till the rate until the rates are done, and then that's kind of where the drop happens. Okay, so right now is actually a good time to buy. And it's actually a good time to sell options because these are pretty much ideal conditions to sell. So that's what a good pullback is. And recently, I just measured it today. I think we went down 4.7 or 4.8%. From the high. I do have positions that are threatened currently, and I'm going to be working through that. So I use a delta of 10 to 12, usually to collect between 60 to 75 cents. And that delta on the short leg or the bull spread will give you that amount. So you'll notice too, when you put on a trade and it's 12%, when volatility is higher, you'll get a bigger premium. When volatility is lower, you get a smaller premium. That's just how it works. This is a 30 to 45, and in this case, these are 5 wide, okay, not 10 wide. On 10 wide, you'll get between 60 to 75 cents, and sometimes even 80, depending on where you get in. An acceptable take profit is 50 to 80%. What I do is when I put on the trade, I immediately set my take profit to 10 cents. That way I have all my orders in front of me and know where that premium is versus what my goal is to get out. Most of the time I'll take between 10 cents and 20 cents depending on the market condition. So for positions that have been rolled, profit target should be 20 to 50%. And the reason for that is because when you roll a trade, you're actually not going back to a 12 delta. You're going back to a higher delta, and there's additional risk there. That's why you don't want to push it. Just get out of that trade and be done with it. Although I'll figure out how to get that max profit. That's just what I want to do, is get that max profit. I work to make that full profit as much as I can. All right, you want to initiate a roll within 20 to 50 points. Sometimes it doesn't work that way. That's why I have positions that that get breached sometimes. And there's a way to manage those as well. We'll talk about that. But ideally, you want to roll that trade really before it gets to like 30 points. If you get closer to the money on that, it costs more to roll the trade for the same work because I adjust and roll the trades almost exclusively. Let's talk about the trade plan. Okay, I'm just going to go over this pretty quickly because you're going to be able to look at this and you can actually download my trade plan at any time. This morning I could tell you that bond rates were up. It was close to 1.8%, and the 10-year futures were down. The dollar was in a range bound mode. The VIX was at 21 this morning. When the market opened, and so I understand where the markets are and where those indicators are. And then now, especially with bond rates are super important because that's what's really guiding the movement in the market, now. And so track it, just look at it today. Look at the 10-year bond rate, which is in Thinkorswim, the symbol is TNX, okay? And that's actually the bond rate, not the bonds. It's actually the bond rate. And you'll see that there's a pretty good correlation between bonds going up and the market going down and vice versa lately, just because that's what's dictating what's happening in the market today, because we're policy is changing and that's what's happening. Okay, so be educated on these things, understand that. Because it's, it helps you in your trading and when to trade and when not to trade. Post-market routine, if you have a trade journal, use it, especially if you're new to a particular strategy, and make sure that you update that, for all your trades and understand what goes through your head when you're trading. Determine if rules were broken and why they were broken. Are they guidelines? So the real rules are for you? What decisions are you making based on that? Determine if the risk is within acceptable levels for your trades. So if you put on a big trade and you make a lot of money on it, that tends to build complacency in your trading, okay? So you got to be careful with that. And we came off a really, really good year. And I can tell you that I had some complacency because I thought it was going to be a great January, and look what we got, right? So we got a big drop. And so those things play in, and you want to kind of take a step back always, and you're always learning as a trader, okay? You always want to take a step back and say, hey, do I have the right mindset? Am I doing this right? And so these are really, really important things as a trader to understand and to go through. here is the entry for a SPX 7DTE trade. And again, I'm putting on not the full position, right? But I spread it out into 1/3, actually, they should be. And spread it out into separate expirations. This tells you the delta here, this portion here. For bear spreads, which we didn't cover, if you do put on call spreads, I like to use 7 to 10 or even less than that. Because again, it's much harder to adjust a call spread than a bull spread. Favorable conditions is when volatility is higher and you put on that trade and let it run, and then volatility is lower. And you can look at the VIX ranges, right? For the most part, right now we're in a high range, and that way it keeps you out of trouble. And again, you'll have access to all this. And then this is the trade management process. Just want to touch on a couple things. I never allow a 1 DTE trade go into the next day. I'll roll that trade or close it. That's what I do, just because of overnight risk. In case of an iron condor, what you want to do, if you have an iron condor and the trade goes against you, you want to adjust that trade in tandem. If the market is going against you, right? If it's going against you, and it's going down, let's say, right? And you have a bull spread on. You have a bull spread and a bear spread, and the market's going down. You want to adjust that. You know, the call spread is gonna be losing value, which is good, and the put spread is going to be gaining value. So you want to move both sides down in order to get a balance between the two. So anyway, this is all built into the plan, and I want to encourage you to just to go over it and read it. And then I want to go through this particular adjustment. I'm going to walk you through that. So here's an adjustment that I've used in many presentations. Let's go through this. So, and this is when I was using 5 wides, all right? And it works exactly the same way for 10 wides. I put on a bull spread here. Sell to open a bull spread, collect 45 cents on it. And then I put on, at the same time, I put on a bear spread and I collect 40 cents on it. So you can see here that the delta is a little bit lower on the call spread. So we go forward and the market moves up. So the market moves up and the bear spread is threatened. And I was able to, because, you know, it was that cheap, because I did it early and allowed to adjust that before it, you know, got close to the money. So we had a few more days. There was decay and the market stayed within a range. And so I collected at the beginning 85 cents. I paid 5 cents to roll both sides. So any questions so far? So let me look here. All right, so now let's look for a trade here, okay? So I'm going to open up my Thinkorswim. I'm going to select 1 month, 2 strikes, vertical. What I'm going to do, I'm going to go out to January 18th. I'm sorry, 18th of January, because it looks like there's a couple days off here. I'm going to select a position. So now what position, what delta are we using again for the put spread? Okay, I'll let you, I know you can't see it. I'll let you know what it is. So I'm going to select the position where that delta is. It's way down there. Is 44.15, 44.05. Yes, we can place the trade. We're going to be able to place the trade. So the position is 18 January. 44.15 put, that's the one I'm selling, and the one that I'm buying is the 44.05 put, and this is live. I'm gonna be placing the trade, okay? And the credit is 80 cents. So remember I told you that when we have high volatility, you know, the premium goes up, and this is exactly what is happening. It's not a call. It's 6 to 8 delta, but don't put it on. Don't put on a call spread because I think the market's gonna be going up, okay? So I'm gonna, now that the premium went down to 70 because the market's moving, it's actually 75. So I'm gonna go ahead and place this trade. Okay, it's not coming in. I'm doing it for 70 cents. Yep, nope, the market moved really quick. So I'm gonna change it and I'm gonna bring it down to 70. Okay, so I'm putting it on for 70 cents. I'm keeping the strikes the same, and it didn't fill yet. It filled, okay? So the trade filled. I think you can hear the beep. And so here's the trade that I put on. So I placed the trade, and right now I'm going to look at my trade. It's filled, okay? I'm going to do an opposite trade on it that got filled, and I'm putting it for 10 cents. Good to cancel. So that trade is in, and it's executed. And I've got a buy order for 10 cents, and it actually moved back up to 80 because the market's a little volatile here. So that's the trade, and hopefully this will work out for us. So are there any questions so far? So keep in mind, this trade that I put on, 44.15, 44.05, which means that right now the market is at 46.05. So in order for this position to be breached, it has to go down almost 200 points in order for this position to be breached. And it looks like we may have caught the bottom on this one, I think, but I'm not sure. But we may have caught the bottom. So remember, this is for 8 days out, and you want to take profit between 10 and 20 cents. All right, so let's go through some questions here. And just remember too, on this trade, even if we didn't catch the bottom, you got 200 points. 200 points for this thing to go bad on you. What are the profitability factors that make 7DTE a high probability trade? And I can pull up the slides again on that. Boom, profitability factors. So what are the profitability factors that allow this trade to be profitable? Taking losses quickly, placing your trade when volatility is low, implied volatility, theta, and market direction. So this is kind of a trick question. Because for those of you who answered 2, you're correct. But no, actually you're not correct. Volatility, you don't want to put on a trade when volatility is low. You want to put it on when volatility is high. All right, I can see the market moving higher, and that trade that we put on is now at 65 cents. Woo-hoo! No, actually 60 cents, so we're profitable. So here are the profitability factors, guys. That I went through. Implied volatility, with volatility moving lower, placing a trade when volatility is high, then decreasing, significantly reduce the initial premium collected. Profitability, right? Theta, it's the rate of decay. And then third is the market direction. So great. Most of you got it right. And I'm going to close the poll here. And the true answer is number 3, right? Okay, let's go through another one. This is good. Little math, right? But it's important that you understand risk reward on these. Okay, guys? All right, so you have a 6 contract, basically 6 contracts and a 10 wide. So we take the 75 times the 6, right? Or the 6 contracts, and minus the premium that you collect. And that's basically the max loss that you would get. So it's the 6,000 minus the 550 would give you the 5,550 max loss. That would be the max loss of this trade. And an easy way to remember it, just say 6,000. You're going to lose $6,000. Minus the credit that you received. On this, but you understand the max loss and the risk reward on this trade. Okay, really important. Most of you got it right. Very good. So let's go. I'm going to close this poll now. Oh, I'm going to give you an easy one. I'm going to give you a real easy one. All right. Okay. What is the delta that you should use for a put credit spread? Put credit spread. And for those of you guys that did the trade, you should know this by heart. Yes. Excellent. Okay. Good. See, and what happens is you build a routine, right? When you go to make a trade, you just know right off the bat where to go, what that strike is, and that takes away a lot of the thinking that you have to do. It's automated in your brain, okay? And so let me put up that slide here. There it is. 10 to 12 delta. Awesome. Okay, 5 to 6 is for call spreads. 10 to 12 is for 5 to 6 is call spreads, and and I put on 7 to 10, but it's actually even lower than that now based on my new trade plan. Okay, let me see. One more poll, one more question, and that's it. And then we can end the session for today. Here it is. One more. Now I think I mentioned this, but I don't think that I wrote it down. I think I mentioned it. Okay, so if you miss this one, it's okay. 30 to 45 for a 5 wide, correct. It's really 50 to, I said 60 to 80, around there. But you know where to go. So anywhere from 50 to 90 is fine. Okay, for these, for getting a good premium on these. All right. Okay, that covers it for today. Any questions Any questions? Where can we see the result for the past? Oh, my results. Here we go. There's a performance on there. All right, guys. We're 2 minutes over. I think that covers it. Tomorrow, ramp up your questions if you have them, and we'll cover that at the beginning, and then we'll do this again tomorrow. And then to answer your question, this performance starts with 6 contracts. Yeah, it starts with 6 contracts and ends with 10 contracts. Okay, so there's 6 contracts every expiration period. So, but again, regardless, if you use the same guidance, the guidelines, you'll get the same kind of return that I got. All right. All right, guys. Thanks. I hope to see you here tomorrow. All right. Thanks a lot. We'll talk to you later.